Hello, this is Mark Smith. It's July 2016, and I hope you're enjoying the summer so far. To accompany second quarter reports, we've prepared this brief market summary and outlook video. As a reminder, this video is best viewed in full screen, and you can always pause and resume the video by clicking the screen. Well, markets were very calm for most of the second quarter until Britain's unexpected vote to exit the European Union. After a few days of volatile trading, the U.S. stock market ended the quarter with a small increase, while foreign stocks were mostly down. Within U.S. stocks, both large cap and small cap stocks posted small positive returns. This section highlights the first interesting observation. Notice how large cap U.S. stocks have led their small cap counterparts, even over 5 and 10 years. This is a nearly unprecedented relationship, as small caps usually return at least some premium over large caps over longer periods of time. While we don't know when this will reverse, it is worth pointing out that Pinnacle still holds no small cap in their primary models. Within foreign stocks, developed country stocks were down slightly, while emerging stocks did do better. Developments overseas, such as slow growth and very low inflation in key parts of Europe and Japan, translated to concerns over foreign holdings. Then there was the late June Brexit vote, adding a degree of political and economic uncertainty. Bonds rallied nicely in the face of late quarter uncertainty. We have continued to emphasize the low yields bonds are offering. So why the attraction to bonds which have driven up prices? The answer is simple. While U.S. bonds are offering low yields, bond yields overseas are even lower, and in some cases negative. This, combined with an overall flight to quality in late June, made U.S. bonds an attractive safe haven. A couple of interesting notes here. First, bonds have not reversed course so far in July as stock markets have rallied. That's an unusual relationship, which can mean that there is very little conviction in the current bounce in stocks. Here's another interesting observation. If we had a line in this section of the summary for long-term U.S. Treasury bonds, you would see a 10-year annualized return of about 9%. That would make it the best performing asset class, even leading U.S. large cap stocks by over 1.5%. The point to these observations is that unusual relationships can occur with investing and can persist for long periods of time. It's important to realize that fact and also not to get too anchored to these relationships when making decisions going forward. Commodities finally showed signs of life, bouncing from a low point in February, but still being very much in the red over longer periods of time. So how did our portfolios do, and where do we go from here? In short, our primary portfolios continue to underperform their benchmarks. This is expected in this part of the market cycle, as the investment team has reduced risk exposures. While the market continues to churn out small gains overall, we will underperform. Here are a couple slides that show the thinking and the positioning. Many views of the market have led the team to reduce volatility or risk of the portfolios to about 70% of normal levels. Therefore, that allocation decision is driving recent results in our portfolios. To see this in a little more detail, here's the equity allocations within our moderate growth portfolio. You can see where both domestic and foreign developed stocks are less than normal or benchmark weighting. This part of the market cycle requires patience. Waiting for the market to finally turn can take a while, and earning less than the markets in the meantime is certainly not fun. The opposite side of this equation is what happens if the markets continue to go up. There is a contingency plan in place to increase risk exposure should the markets improve. However, signs of true market strength, such as improved earnings growth, momentum, and market breadth would have to show themselves. At this point, the evidence just isn't there, so we wait in a little more conservative position. We appreciate your business and your confidence, and as always, please let me know if you have questions. I look forward to talking with you soon.